Hello guys, welcome back to Zodiac Trader. So today this is the part 4 of the price action course. So today we will learn about triangle. We'll learn about different patterns of triangle and its formation. So let's start. Okay, so we can see here there are two symmetrical triangle formation. There will be a bullish one and there will also be a bearish one. Like the difference is though the market, we see the price is acting like a triangle, and then it kind of breaks the upper, like the upper side of the triangle. And for the bearish part, is we see that the price hit below the down part of the triangle. Okay, so here we see this is the downtrend. If we connect one, two, three, four, and all these dots together, we are getting this as a triangle. This is an obvious one. So we see this is a downtrend, and we are seeing on the right side there is this red candlestick. It's like hitting below the triangle, like the 1 to 2 side, and it is a downtrend. Okay, so we're seeing this downtrend continues to break the triangle formation. Okay, so the next slide, here we see another symmetrical triangle. This is the downward trend line, and this is the upward trend line. And we see here as the blue circle here, this is a breakout, and then there will be another retest because the price doesn't just end there. It kind of bounce back and then further hit like downwards. So the price is retested on the upward trend line. And we see here on the white circle there is a converging point. Okay, so that would be a signal that shows that the market is probably going to hit towards an end of a trend. So this is how we draw. We draw this downward trend line. We will draw an upward trend line. So you see a triangle here. And we shall see if this is a descending triangle or ascending triangle. So if the price breaks out the upward trend line, that's a downward triangle. Okay, here let's look at the next slide. This is extremely long breakout candlestick. So we want to like the best part, the most important part is that you do not trade here because you want to see if this is actually a real breakout, because sometimes it doesn't really break out. So we see, even though like the market has a strong buying power, but then we see like the market retrace back a bit and then it further bounce back. So we're seeing this pattern right here. So be careful not to jump into trade so quickly. So we have to avoid this type of long candle because it could be a trap. So we want to wait till the price to retest so we can further get our positions, so we can open our positions to trade. So in this type of long candle, we better wait for retest the trend line. So where do we start to place stop loss? So there are 7 points that you can start placing your stop loss. Number one is under the low or high of breakout candlestick. So you have greater chance of getting stopped out, but the good this is that is a very short stop loss distance. So stop loss number one, you see the yellow line right here. You have a smaller um, range of stop loss. If you have a smaller account, it's better for you to have a tighter stop loss because the stop loss number one provides a very limited distance. So you see stop loss number two. You see another yellow line here. It's a halfway distance between upper and lower trend line. So it has less chance of getting stopped out. So sometimes when you have very or over narrowed stop loss, what tend to happen is you increase your opportunity of getting stop lost. And so that's why you may miss some of the major trend because sometimes like the price could go backwards. And then you lost the opportunity to actually trade a larger trend because you have a very tight stop loss. And here we see the third yellow line stop loss number three. So it's below and above the outer edge of where the breakout happens. Very less chance of getting stop out. But problem is that stop loss distance can be very large. So it really matters if you have a stop loss number three, you need to have a big account, or either you have a very small or insignificant position to have a stop loss free. So we will talk about money management in the future, but now we will have a simple idea of get to know why we will have in what situation we will have a stop loss one, in what situation we will have stop loss two and three. Obviously, stop loss three is the largest stop loss. Okay, so because by setting this stop loss right here, the market could go against your will. So that means you will end up losing a lot of money. So you better be, you better be really certain about the trend or you will not have a very big stop loss. So we were waiting for the third green candlestick. You see a straight line breaking the upper trend line like here. So we're also seeing this turn to be a resist level. And then after the breakout, we're seeing the market having a massive upward movement after breakout. So this is ascending triangle and its formation. So we see this market goes up and it kind of bounce back and forth, and you see it hits towards a resistance level like repeatedly, and then you have a support level that are rising, and here you see another breakout. So this is a typical bullish pattern that you see a triangle, you see an upward triangle, and then you see another breakout. That normally means the market will go up, so it's a bullish pattern. So stop loss, same as symmetrical triangle. So try to have a target one to two to three times the distance. So here you see the chart. You see this is the rising support level. This is the constant resistance level. And then by connecting these two lines, then you're getting a triangle. And now you're having this breakout because the market is breaking the upper consistent resistance level. And when to take the profit? It's best to take profits the first resistance level. Okay, so you do not like take profits in the midway. You want to see at least the price could bounce back a certain point once or twice, and that's how you realize, okay, it's not going anywhere higher. It's hitting to a resistance level. That's when you stop your profits. That's where you take your profits. So here you see this is a rising support level, and then here's if you are placing your bet after the resistance level, like you should enjoy a greater profit since it's already breaking out. So here we're seeing this descending triangle formation. We see this resistance level that are falling. This is a downtrend, and we see a support line. And then the market goes back and forth and finally breaks out the support level. So in a sense, we're seeing this chart. We see a massive downtrend, and then we're seeing this small triangle, and then we see another breakout. So this is a descending triangle formation. So descending triangle, there are different scenarios. So here we see a breakout. That means if you see the candle was still in the midway of the candle, that means the traders can enter the trade without hesitation. But if we're seeing the descending triangle having this, so we are having more straight line than the red area. We're seeing this very slim straight line sticking out of breakout. That means the trader cannot enter the trade because there is no volume right here. So if we look at the chart, this is the height of the triangle used to determine the profit. And we have a descending triangle. We have a strong support right here connecting the lower point. And we have a stop loss right here. We have a breakout right here. Okay, we have a profit limit, sorry. And we have a stop loss on the top because it's a descending triangle. You expect to sell the market. That's why your profit limit is on the downside. Practice work to find ascending and descending triangle pattern. Like my advice is that you can take out like daily chart or maybe monthly chart of S&P and try your best, try to find triangle, ascending triangle and descending triangle, and 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 kind of draw that on the paper. By doing that, you actually become more familiarized with the S&P and the market trend. So this is very important. Now we are looking at a reverse pattern. We are looking at the head and shoulder chart pattern. So this is a bearish chart pattern. So we found this in uptrend. It gives signal end of the uptrend. So when we see this head shoulders pattern, we are expecting a market reverse. If you're long the market, when you see the head and shoulder, it's time for you to short. If you're seeing this head and shoulder for like completely formate. If you see the formation of the head shoulder, better to go with the opposite directions. So here you see this is the left shoulder, this is the head, and this is the right shoulder. And you will connect the low and then you get a neckline. And on the right side, you see the market breaking down that neckline, becoming like a breakout. So this is a head and shoulder top reversal pattern. Okay, so when you see that from a Kinto chart, it's more obvious. You see 3 points right here. You see 3 high points. And then there's a neckline. Okay, when you're connecting the downward trends, when you're connecting the low, you get a neckline. And then because each time the market doesn't go up higher, that's why it's going reversely. So you see the price hitting below that neckline. That's why a head shoulder pattern, it's always like most of the time could be a great sign identifying a reversal pattern. So how to trade? So this is a typical head and shoulder pattern. So we will put the stop loss on the third, which is the right shoulder. And then after the price break the neckline, we will go short the market. Okay, and then after the price bounce back to the neckline, that's the time when we short another time. Okay, so my suggestion is if you are trading one direction, try the best to keep and remain on one direction. Because if you try to make money on both sides, it could be really confusing and really it could be bad for your account since you'd be losing a lot of money because you don't know what like how short you will go, and sometimes it just go backward. Like in this case, it go back to the neckline, and if you are like short and then you long, you're doing both direction, and then you're hitting that neckline. and sometimes you don't know where to place that trade, and then if you do not take profit immediately or in time, you end up losing money here. So my advice is try to remain just one direction. Try to trade only one direction. That's how you keep profits. So the second short would be if price rally backs to the neckline, go short on the reversal signal and place a stop loss above the resistance level. So how do we set target, the price target? So this is a candlestick version of head shoulders. We're seeing this neckline. We're seeing the price break the neckline and makes a nice move down. All right. So the blue one, the blue area is where we put the limit, the price, the profit limit. Okay, so inverse head and shoulder pattern is the reverse pattern of head and shoulder pattern. So this is a bullish pattern because this is opposite of head and shoulder pattern. Now we're seeing this inverted head and shoulders as a reversal pattern in a downtrend. So actually you see here, this is the left shoulder. The market goes like massively short and then it come back to the neckline and sell it again and then come back to the neckline and do it again. So this would be the lowest part would be the head at the right side. You see this neckline and also crossing another upper trend. This is the right shoulder. So to identify this on the candle chart, it might look like this. So this is the left shoulder, this is the head, this is the right shoulder. And on the top, you see the neckline. And here you see that the market breaks, the shoulder market that actually it's a breakout. So we are seeing the price going up higher. It's breaking the neckline and continue to move up. So this is a bullish shoulder, head to shoulder pattern. Okay, so we take profit target on the like the blue side. We see the blue area right here. This is where we take profit target. And sometimes you want to wait for a little bit. You want to see if the market is retesting. You don't want to rush yourself to trade. So you can do that. If you have spare time, you can find 5 head and shoulder pattern and 5 inverted head and shoulder pattern. And as I have mentioned before, print out a daily or like weekly or monthly chart of S&P. And when you find this head and shoulder pattern, you will realize how actually, that if you be able to identify these patterns, it'll be much easier for you to trade and to recognize the structure of the technical analysis. Here, we see another form of different chart pattern. We're seeing a double bottom chart pattern. So unlike the head and shoulder pattern, there are 3. Here we only see 2 of the triangle. So we see this is a bullish reversal chart pattern, and this is starting of an uptrend. So it looks like you have a W shaped as a formation, and you see like the on the bottom of this W, you see these support lines, and you see this is the resistance level, also named as a neckline. So when market breaks out the right bottom, it's a bullish signal. So sometimes here you see this is a candle chart, you see bottom 1 and bottom 2. Not like when you see 3 bottom, that would be a triple bottom, but when you only see 2 bottom, that will be only double bottom. And then you see this price breakout. When you can try to do this, try to find this in S&P, right? You always need to do a lot of homework to make sure that you actually have the deeper understanding of the market structure. So this is the neckline, this is bottom one, this is bottom two, and this is the distance between neckline and bottom. So the price moves up. Here to this is the blue area is where you take profit. And this is a double top reversal pattern. Again, we're seeing double peak, not double bottom. And you see price breaking down that neckline, becoming like a negative breakout. So how to trade? Like after the breakout, we sell on peak 2. When you get confirmation and you wait for retest the broken neckline. So this is the first peak, this is the second peak, this is the existing uptrend, and you have aggressive entry point on the second peak, meaning that you can go short. And here you have a conservative entry point, like because in reality you don't really know if the second peak is the peak, so you probably need to wait for a little more. It not necessarily you're gonna have a aggressive entry point, because that would be like trying to predict the future. You will like what happens if this is not a double top down, like double top chart pattern. Like the market could go up massively, right? So my suggestion is always wait for the neckline. When the formation, after the formation of neckline, you see the price going twice but unable to break that price, that's when you place your trade, right across that neckline. That would be much safer. So the first top, the second top, this is like two triangle. It's like a inverse of W, which is an M. It looks like a character M. And here you see the market go back and further and retest the neckline, and then it continues to drop. So this is the triple bottom, bullish reversal pattern. So as I have said before, you have double bottom, you have free bottom pattern. So you have to wait for a bit. If you are like being too aggressive, you are not willing to wait for that neckline. Sometimes it will go from double bottom reversal pattern to triple bottom reversal pattern, right? So that means you would take more time for you to become profitable, or either you got stop loss too early to enjoy the entire like market profits. That's the problem. So this is the triple bottom. This is a downtrend. This is the first bottom, second bottom, third bottom, because you keep hitting on the resistance, the support level, and then you see the market going up. This is a trend reversal. So how do you trade? You wait after the breakout of neckline. So neckline is extremely important when it comes to trading triple bottom. So you want to wait for retest the neckline, and then you try to enter the third bottom, right? So your target would be the same, where you place your profit and loss limit. So this is a triple top. This is a bearish chart pattern. You have three peaks, you have neckline, and then you have breakthrough. So here we have mentioned about Doji candlestick before. Now we show you a different ways of candlestick patterns. There are many forms of candlestick patterns. So where I use this candlestick pattern, you use to when it's hitting support and resistance level, and you see there are different forms of Doji star. You see it looks like a star because it's all thin and there is no red triangle, red rectangular. Like you see no volume, that like means the buying power and the selling power at this point is it's almost equal, right? You're not seeing like any of the power getting any advantage. So that could means the market is hitting towards a reversal point. So the first one is, it looks like a cross, but we name it as Doji. The B The B1, the second one, it looks like a gravestone. So, I don't need to explain what looks like a gravestone, right? So this is a gravestone doji that typically that's a very bad signal because that means the market could go like, low. And C, that's a dragonfly doji. That means that you have this like a T, look like a T, and then you have a long leg doji. It looks like a longer version of the cross. So you have four types of doji candlestick. You have doji, the first doji that you have to bet, like you have to gamble because you don't know if the price is going low or going high. You could go like two different directions. So that's why either the doji star would be either bullish or bearish signal. So the second gravestone about doji, that would be a bearish reversal signal. So you can find that in uptrend and resistance level. And dragonfly doji, okay, this is a bullish reversal signal. When you see the dragon going up because the price, you have a lot more volume here. So that's why you have more volume here, even though you couldn't see that, but the price have more volume and then the downside. That's why you have a crossing line here. That means it's a bullish reversal signal. So you can find that dragonfly doji in downtrend and support level. So you have long leg doji, which is the long cross. This is typically like compared to the doji, that actually means that a bigger leg doji means the market momentum would be a lot stronger, but you are not sure if the market is going up or going down. But that always means there will be a strong market momentum forming. So this is a very classic doji candlestick pattern. So you see the doji star right here. Okay, so it becomes like a reversal signal. You see very strong downtrend after it. Okay, so you have different engulfing of the candlestick pattern. You have bullish engulfing and you have bearish engulfing. So you have bullish engulfing, can find that in support level and the downtrend, or you can find that in the bearish engulfing or found in the resistance level / uptrend. So you have different engulfing to look at it. Okay, so that's for today's video. We still have a little bit left to really understand the entire section of price action strategy. But so far we have learned about, in this episode, I've learned about Doji Star, we've learned about triangle, we have learned about triple top, double top, we have learned about head shoulders and different patterns of reversal patterns. So try your best to print out an S&P paper, a chart, and try to label all these patterns on the chart. So thank you guys for watching this video. I will see you in the next one. And in the future, I'll try to make more of these videos as possible. Please click like button and share to your friends. Thank you. I'll see you in the next one.